Hey guys, how's it going? I'm going to tell you exactly the steps that you need to take to buy an apartment building today. I'm going to assume that you're already chosen to buy an apartment building. You know that it's going to be a good fit for you. You have to weigh the pros and cons of whether or not you actually want to buy and want to be the managing partner in an apartment building, because there's a lot of pros and cons with it, like depending on the lifestyle that you want to live. And if you buy the wrong building, it can turn into a job for you. Some of them can be a big headache. So you really have to narrow down why you want to buy an apartment building and what the reasoning is behind that. Like if it's actually a good fit, and be honest with yourself, because maybe you're better off being a passive partner and dealing with none of the headaches. So there's two options there, but all this is assuming that you've already gone through all that and you know that you do want to buy an apartment building. So I'm going to show you how you would go about doing that today. But number one, you need help. If you're just starting out, you need somebody around you, somebody you can bounce ideas off of. A team member, a mentor, something like that, especially considering the size of building that you're buying. Like if you're buying a 12 plus unit apartment building anywhere in North America, like it's expensive. So the amount of capital that you have to put up to help get somebody to help you learn is definitely worth it. And then, just setting yourself up with team members. And by that, I mean, make sure you have a lawyer, make sure you have a good accountant. You have a broker maybe to help you find buildings if you're not going to go at it off market. Commercial mortgage broker, so basically somebody that helps you get the type of financing that you want. There's a whole bunch of people that you need on your team, but that's definitely what you would want to do first. Number two, you find out how you're going to pay for it. You have to figure this out fairly soon into the process. If you're going to pay for it yourself, if you're going to use investors, how are you going to use investors? How are you going to structure the deal? How do you want to structure the deal? Working with investors, if you've never worked with investors, it requires a mindset shift. First and foremost, you need to believe that you're a real estate investor, believe that people would want to invest their money with you, believe that you do have a product to offer people, because that's the hardest one to get over. It takes a long time. It takes a lot of years just to shift that in your mind and get over that whole why would somebody want to invest with me mindset. And then basically just tell people what you're doing. You'll be very surprised at who wants to invest with you just by telling people what you're up to, what you're looking for, what you're trying to do. Number three, what type of building do you want? And this could mean anything from like Class A, Class B, Class C. So Class A is like your skyscraper downtown, lots of amenities nearby, newer building. Class B, it might be a newer building in some area on the outskirts of town. Not many amenities nearby. Maybe there's lots of amenities, but it's a little bit of an older building now. That could be a B-class building. And then a C-class building. This is a neighborhood where the demographics are starting to shift. It's a little bit rougher. And then once you realize what class you want, then you can go into the type too. Like, do you want a wood frame? Do you want a concrete building? Do you want a pitch roof? Do you want a flat roof? What size of building do you want? There's so many different variables, and you should hone in on what type of building you want that fits within your financing parameters. Don't start out with a huge building if you've never even been in real estate before, because you probably won't be able to pull it off even with the financing parameters. And then start analyzing deals that are comparables to the building that you want. Number one, analyze lots of them. If you analyze lots of deals, then you'll start to realize what a good deal is and what a good deal isn't. I would recommend analyzing deals in different markets, because you might be in a really hot market and you don't even know it, or you know it but you just don't know the exact scale of it. So it doesn't hurt to analyze deals in different markets, just so you can kind of compare and find out what a good deal is and what a good deal is to you. I analyze deals online, so I just started doing this. And basically what I'm doing is people are sending me deals, asking me if it's a good deal, if I would buy it. And I'm actually analyzing them for you guys now, just so you can kind of see how I look at deals and how I would analyze a deal and see whether it's a good deal or a bad deal and just stuff like that. And I run out projections on all my deals. Like I figure out exactly how investors are going to be paid out 20 years later. And plans probably will change, but as long as the intention is there and as long as you have a plan. And then once you have that plan, then you can make a more informed decision. You have to analyze how you're going to purchase it all the way up to the sale. Like, do you plan on holding it for 5 years? Do you plan on holding it for 25 years? That all plays into it. Your time frames, your cost of capital, that goes into analyzing, because you have to know that there's going to be a good ROI, return on investment, on that building to be able to attract investors. So you actually need to know your cash on cash, and you should have an idea of what your IRR or internal rate of return is. And something with that calculation, that's a calculation of how a building performs over time with many different variables like your cash flow, your capital pay down, your appreciation, all that stuff goes into IRR. And you can't actually make a very informed decision based on IRR, but you should look at it. And you can project it, but it's just probably not going to be very accurate because you don't know where the market's going to shift. You don't know what's going to happen in 7 years. Like you can project out 5 years maybe, even that's probably pushing it, but 7 years, 10 years, you can't project that far. When you're analyzing, figure out how you're going to offer, like what kind of offering method do you want to use. You can come in, you can offer asking price. I know lots of people that do that. And then they'll come in, get all the financials, they get the contract accepted first of all, so then they have the property secured, nobody else can take it. And then they'll actually come in, go through the financials, and they'll offer, like say it's, like I said, a 12-unit building and it's going for 1.2 million, 100,000 a door, say. Somebody will offer 1.2, and then they get the financials and they actually offer like, come back and counter at 900 with like maybe a vendor take back or something. Like they really play hardball. And that's one way to do it. Or like I'm working on a deal right now. I can't come in too low or he won't even look at it. So I need to come in ballpark, but it's a catch-22. He won't release the financials until I show that I'm serious, right? So I have to put an offer in, probably show proof of funds, right? So what I need to do is I need to come in close to market value. And then what I'm going to have to do is go through the building, go through the financials, and then anything below that price, I'm going to have to actually justify it and like really justify it, why the value would be so low. And how I would do that is I would look at like what kind of maintenance needs to be done, the roof, the windows, what condition are the units in, boilers, mechanical, all that stuff you look at, and then just start knocking value off. Number 5, purchasing the properties. You have to think about the contracts, joint venture agreements, corp on title, and this will all vary depending on what type of deal you do and what type of capital that you bring in. So if you are working with investors, you're probably going to have to put together a joint venture agreement. You might need to put a corporation on title, depending how you want to do the deal. So with these deals, there's so many different variables. That's what I love about real estate is you can do it any way you want. But yeah, just stuff to think about. That's all I want to do today here is just give you a good template of stuff that you should think about before you get into your first deal. Number 6, are renovations and stabilization. So now you actually have the building. Now we're going to get into it. And you actually should look at all this stuff obviously before. If the rents are low and you need to stabilize the building, if expenses are high, you need to go in and cut expenses. That's stabilizing the building. If the building is in general need of renovations, it's something you should look at. And then I would be looking at who does the reno. If you're going to do the reno yourself, then it's going to take a lot more of your time, so just be aware of that. If you're going to hire it out, just make sure that you're using a qualified professional and make sure they're insured and all that stuff. Managing and reporting. You need to manage trades. Obviously, if they're doing work in your building, you need to watch them and make sure that they're held accountable to do things to your standard. Reporting, how is the capital being spent? You should be getting reports from the trades that are doing it, if you have a general contractor on it. If not, you're building the reports and you're reporting back to the investors probably. Operations and investor disbursements, you have to think about this. Do you want your investors paid out monthly, quarterly, annually? How do you want to do it? Do you even want to do cash flow at all? Do you just want to do equity or do just cash flow? Like there's a million different ways to do it. So, and then operations. Who are you going to get to operate the building? Are you going to get a third-party property management company? Are you going to manage the property yourself? And if you do, I would watch out because depending how you finance the deal, the bank or the lender might not let you manage the building if you don't have the experience to do it. So that's the basics of how you buy an apartment building. So hopefully you guys enjoy that. There's a lot of other stuff that needs to go into this. If you ever have any questions, just reach out to me. You can do that on my website. You can do it on Instagram, whatever, and or wherever you can get a hold of me. And I'll do my best to help you. So yeah, like I said, though, tune in. I'm going to be doing some analyzing deals and showing you guys how I would look at deals. So if you like this, hit the subscribe button and I'll see you guys later.